Yes. Okay. So, hello, my dear students. I welcome you all for CA final revision series of direct taxation for September 2025 examination. So, as part of revision series, today I am going to start with DTAA. So, I am thinking to discuss four topics: DTAA relief, second one, foreign tax credit, FTC, foreign tax credit, third one, exchange rate for conversion of foreign income into Indian income. Fourth topic, exchange rate for conversion of tax paid in foreign country into Indian currency, INR. Okay, these four topics I am going to discuss with you. After we finish discussing these topics, we are going to solve two problems as well for your better understanding. DTAA very important for your examination. Like easily you can expect more than 10 marks from DTAA. That much important this chapter is. So please listen carefully till the end of this revision class. Okay. Now let's get into the concept. Give me 1 second. Now, sir, what do you mean by DTAA when there exists the concept of double taxation avoidance agreement? See, if one income is taxable in two different countries in the hands of same SSC, then we can say there is double taxation. For example, like Virat Kohli went to Australia, he played in Australia, he earned income in Australia. On that income, Australia will levy tax, India will also levy tax. See, SSE is only one, Virat Kohli. Income earned is also only one. Okay, like man of the match, $10,000. On this $10,000, Australia levied tax, India also levied tax. That means on a single income in the hands of same SSE, if two countries levy tax, then we call that concept as double taxation. See, double taxation is harmful. Why double taxation is harmful? On one income, if two countries levy tax, nobody will show interest in doing cross-border transactions. Nobody will show interest in doing international transactions. So, like double taxation is not at all good. So, countries came forward to provide relief to double taxation. That relief we call as double taxation avoidance agreement. So, like countries, any country will levy tax on two bases: source basis and resident basis. Sir, what do you mean by this? Source basis means the country in which income is earned, that country will levy tax. Resident basis means if a person is resident in India, then that particular country will levy tax on global income of that person. I am Umasankar. I am resident in India. So whatever the income that I earn, Indian income, foreign income, on entire income, I am required to pay tax in India as per which rule? As per resident rule. Are you able to understand? Justin Bieber came to India. Whether Justin Bieber is resident in India? No. Justin Bieber is non-resident. So Justin Bieber earned income in India. So when Justin Bieber earns income in India, he is required to pay tax in India based on source rule. Are you able to understand? So that is resident basis and source basis. Give me 1 second. Come on, Jayant. I should have shared at least my mom number with you. The live middle. Now, let us discuss further. So, source basis means what? The country in which income is earned. If a person is non-resident in India, like if he earns any income in India, even though he is not resident, India has right to tax on income earned in India on source basis. That is source basis. Resident basis means what? If a person is resident in India, he is required to pay tax on global income. So, what happens? Like Virat Kohli went to Australia, earned man of the match. On Virat Kohli, tax is levied by Australia on source basis. Tax is also levied by India on resident basis. So, using resident basis and source basis, if two countries levy tax on same income twice, it will lead to double taxation. Double taxation is not encourageable. Double taxation is harmful. Nobody will show interest in doing international transactions if there is double taxation. So, to counter double taxation, many countries came together and they are giving relief to avoid double taxation. So, what is DTAA relief? This DTAA relief will be given in two ways. DTAA relief can be bilateral relief or DTAA relief can be unilateral relief. Sir, what do you mean by bilateral relief? Bilateral relief means two countries' representatives will sit together and they will draft double taxation avoidance agreement. Okay, they will come to conclusion. If one country levies tax, another country will not levy tax. So, to avoid double taxation, one, if source country levies tax, resident country will not levy tax. Or if resident country levies tax, source country will not levy tax. In such a ways, two countries' representatives will enter into agreement and provide double taxation relief. That type of relief we call as bilateral relief. Are you able to understand? Now, sir, what do you mean by unilateral relief? See, India is not having double taxation avoidance agreement with any other country. In such a case, other country is not supporting to India. In such a case, India itself will give relief for double taxation using unilateral relief. So unilateral relief is covered under section 91. Bilateral relief is covered under section 90, 90A. Now, bilateral relief can be provided in two ways. Bilateral relief can be provided using tax exemption method or tax credit method. Tax exemption method or tax credit method. Sir, what do you mean by tax exemption method? Tax exemption method means one country levies tax, another country will not levy tax. That means he is required to pay tax in only one country. That concept we call as tax exemption method. In the example of India and Australia, Virat Kohli played in Australia, right? If India levies tax, Australia will not levy tax. Or if India do not levy tax, then Australia levies tax. That means if one country levies tax, another country will give exemption on that income. Another country will not levy tax. That concept we call as tax exemption method. Are you able to understand? So one country levies tax, another country will not levy tax. That concept tax exemption. So simply if one country levies tax, it is exempt in another country. Next, what do you mean by tax credit method? In case of tax credit method, resident country levies tax, source country also levies tax. But whatever the tax paid in source country is there, that is allowed as credit from tax payable in resident country. Are you able to understand? For example, in resident country, tax is 1 lakh rupees. In source country, tax is 80,000 rupees. Whatever the tax paid is there, that will be given as credit and only balance 20,000 is payable in India, resident country. That type of method we call as tax credit method. So to avoid double taxation, two types of reliefs are there: bilateral relief, unilateral relief. When it comes to bilateral relief, again it is provided in two ways: tax exemption method or tax credit method. Sir, what do you mean by bilateral relief? Two countries representatives sit together and they will come to conclusion on various aspects, on various incomes, how taxes are going to be levied, and they will write one agreement. That agreement we call as double taxation avoidance agreement. And DTAA relief can be given either in tax exemption method or tax credit method. Next. So basically what India follows, generally in most of the double taxation avoidance agreements, India follows tax credit method. That means if any income is earned, India will tax, source country will also levy tax. Whatever the tax paid in source country is there, that is given as credit in India. Okay. So in most of the double taxation avoidance agreements, what India follows is tax credit method. Now, what section 90 says? As per section 90, India can enter into agreement. India can enter into agreement DTAA with any foreign country. Any foreign country or specified territory. Sir, why DTAA is entered? The primary reason why DTAA entered is, first reason is to avoid double taxation. To avoid double taxation. Second reason why DTAA is entered is to exchange information in between two countries. For example, India UK have double taxation avoidance agreement. Now what India will do, like why DTAA entered, primary reason to avoid double taxation. India will ask UK to share tax details of Vijay Mallya. Then UK will share tax details of Vijay Mallya. So another reason why DTAA entered is to exchange our country information with another country and to get another country information to India. So for this purpose also DTAA can be entered into. Next, sir, what do you mean by specified territory? Specified territory means a particular area in the country. For example, Hong Kong is there. Hong Kong is part of China, but only with Hong Kong you can enter into DTAA. Macau is there. It is not a country, it is a specified area. So not only with countries, but with any particular area in a country, India can enter into DTAA. Who said? Section 90. Section 90 gave power to India to enter into double taxation avoidance agreement. Next. Section 91. Specified association of India can enter into DTAA with specified association of another country. Can enter into DTAA with specified association of another country. For example, RBI is there. RBI is Bank of Banks in India. So RBI is one specified association in Indian country. Similarly, Swiss Bank is there. For example, let us consider Swiss Bank is the highest bank in Switzerland. RBI can enter into double taxation avoidance agreement with Swiss Bank, but it should be ratified by both the governments. Then only this DTAA is effective. Are you able to understand? So one country can enter into DTAA. Not one country, one specified association of a country can enter into DTAA with specified association of another country. That DTAA is also valid, but subject to the condition like that should be approved by both the governments. Then only it is valid. Sir, we were discussing double taxation avoidance agreement, right? Provisions of DTAA. provisions of DTAA or Income Tax Act 1961, whichever is more beneficial to the SSC, that is applicable. That means what? Let's say DTAA says tax rate is 20%. Income Tax Act says tax rate is 30%. Whichever is beneficial means 20%. So 20% tax rate is applicable. So very simple, provisions of Indian Income Tax Act or provisions of double taxation avoidance agreement. Out of these two, whichever is more beneficial to the SSC, those are applicable. Next. But there is one exception. What I said, provisions of DTAA or provisions of Income Tax Act, whichever is more beneficial to the SSC are applicable. One exception is tax rate of foreign company. In case of foreign company, what is the tax rate applicable? Tax rate applicable as per Income Tax Act 1961 is 35%. This is recent amendment na. Previously tax rate applicable is 40%, but nowadays tax rate applicable is only 35%. So as per Income Tax Act 1961, tax rate applicable is 35%. Or for example, yeah, as per Income Tax Act 1961, tax rate applicable for foreign companies 35%. As per DTAA, if say tax rate is 25%, in that case 25% not 35% tax rate is only applicable. What I said, in general, provisions of Income Tax Act or DTAA, whichever is beneficial to the SSC, okay, that is applicable. However, in case of foreign company, just because tax rate is higher in India when compared with the domestic company, you cannot consider it as less favorable charge, and 35% tax rate is only applicable for foreign company. Very simple, students. Like DTAA, income tax, whichever is beneficial, that is applicable. But when it comes to foreign company, even the foreign company tax rate is higher, still DTAA provisions are not applicable. Income Tax Act only applicable. 35% tax rate is applicable. Now you will get one doubt. Sir, in case of foreign company, for every provision, do we need to consider only Income Tax Act? We should not consider DTAA? No, not like that. Only for tax rate. Are you able to understand? In case of foreign company, only for tax rate, Income Tax Act is applicable. For all other provisions of foreign company, either DTAA or Income Tax Act, whichever is beneficial to the SSC are applicable. Are you able to understand? Next, I will tell one example. Let's say a foreign company is there. Example 1. As per Income Tax Act 1961, income 1, 2, 3, 4 are taxable. As per DTAA, income 1, income 3 are taxable. Now, whichever is more beneficial means DTAA. Only 2 incomes are taxable as per DTAA. This is applicable. That means in case of foreign company also, other than tax rate, for remaining all provisions, DTAA or Income Tax Act, whichever is beneficial is applicable. However, in case of tax rate as per Income Tax Act is 35%. Tax rate as per DTAA is 20%. Now, in this case, 35% is only applicable. That means that is the only exception. Next, tax residency certificate, TRC. Sir, what do you mean by tax residency certificate? See, if a person is earning income outside India, who is resident in India, we are giving tax credit to him, right? So, how can we believe that Virat Kohli paid tax in Australia? So, what Virat Kohli will do? He will produce tax residency certificate. Or let's say Justin Bieber came to India. Justin Bieber earned income in India by performing in Ambani marriage. On that income, Justin Bieber is required to pay tax in India. Justin Bieber may also required to pay tax in USA. Now India is levying tax, USA is also levying tax. It leads to double taxation. Now before we give tax credit to Justin Bieber, we will ask Justin Bieber to produce tax residency certificate. Tax residency certificate consists of PAN number of his country. Okay, what is the PAN number or what is the tax identification number of his country and his address details, what is his name, his address, contact number, all basic information is available in tax residency certificate. Only if non-resident produces tax residency certificate in India, then only tax credit will be given to him. Otherwise, tax credit will not be given to him. Are you able to understand? So that's all about TRC, tax residency certificate. See, till here we discussed various concepts, but from these concepts, the chances of question is very, probability is very low. But whatever the concept that I am going to discuss right now, this is very much important for examination. From this topic only, he is asking all the questions in the examination. So I request everyone to listen very clearly this topic. Next topic is section 91. Till now, we discussed bilateral relief. That means one country levies tax, another country will not levy tax. Or one country levies tax, another country also levies tax, but tax paid in country 1 is given as credit in country 2. Okay, that is foreign tax credit. But section 91 is applicable if there is no DTAA, between India and other countries. Between India and other countries. If there is no double taxation avoidance agreement between India and other countries, then section 91 is applicable. What section 91 says? There are 4 conditions. If these 4 conditions are satisfied, then only section 91 is applicable. Otherwise, section 91 is not applicable. What are they? Condition 1, like person should be resident in India. Person should be, and for every question that you solve relating to section 91, write these 4 conditions also. If you write the provision, like you will get effective marks, 100% of the marks. The person should be resident in India. Condition 2, he is having foreign income. He is having, or you can say he is having income from foreign country. Income from foreign country. Condition 3, he paid tax in foreign country. He paid tax in foreign country. Condition 4, India is not having DTAA with such foreign country. DTAA with such foreign country. If these 4 conditions are satisfied, then DTAA relief will be calculated differently. Are you able to understand? So, if there is no DTAA, then India itself will give the relief. The type of relief we call as unilateral relief. So, generally what? Both countries will enter into DTAA. If DTAA is there, tax exemption method or tax credit method. If there is no DTAA, then India itself will give relief. That type of relief we call as unilateral relief. To get that relief, 4 conditions are required to be satisfied. Person should be resident in India. He should have income from foreign country. He should pay tax in foreign country. See, payment of tax can be direct payment or deduction of TDS in foreign country, both. Okay. Fourth condition, India is not having DTAA with such foreign country with whom SSE has earned foreign income. Okay. If these four conditions are satisfied, then section 91 is applicable. If section 91 is applicable, then how are we going to provide relief? Step 1, we will calculate tax on total income. Calculation of tax on total income. Total income means both Indian income as well as foreign income. We will calculate tax on total income, and we do not deduct TDS, TCS, advance tax, MAT credit or AMT credit. So basically what happens, we will calculate tax, we will add surcharge, we will add HEC, but we do not reduce like TDS credit, advance tax, TCS credit, those should not be reduced. So here tax means what? Tax means gross tax. Gross tax means tax plus surcharge plus HEC. Okay. Don't reduce advance tax. Don't reduce TDS. Don't reduce TCS. Don't reduce AMT or MAT credit before reducing all these. So you will calculate gross tax on total income. On Indian income and foreign income, you will calculate tax. You will add surcharge. You will add HEC. So step 1, you will calculate tax on total income before reducing all these credits. Next, step 2, relief under section 91. Relief under section 91 is equal to average tax rate, doubly taxed income, or we can write like this. Step 2 is average tax rate in India or average tax rate in foreign country. Average tax rate in foreign country, whichever is lower. So you calculate average tax rate in India or average tax rate in foreign country, whichever is lower you take. Step 3, relief under section 91 is equal to doubly taxed income into tax rate as per step 2. Tax rate as per step 2. See, you know tax rate as per step 2, right? Average tax rate in India or average tax rate in foreign country. So out of these two, whichever is lower you need to consider. Whatever the tax rate as per step 2 is there, apply it on doubly taxed income. Thereby you are going to calculate relief under section 91. Are you able to understand? Next, step 4, final tax liability is equal to step 1 minus step 3. In this way we are going to calculate the tax liability. Now, shall we do one example for our better understanding so that it will be very clear for you as well. Many problems are there. Let's do some 2-3 problems so that you are going to get better clarity. Okay. So, there is an individual with the name Rahul. He is resident in India. Rahul is basically resident in India. Now, Rahul total income. So, he has Indian income 9 lakhs, foreign income 5 lakhs. So how much is total income? Total income is 14 lakhs. And Rahul is resident in India. He has earned income from country Y with which there is no DTAA in between India and country Y. In this case, obviously section 91 is applicable. As there is no DTAA, India will only provide relief. The type of relief we call as unilateral relief. Am I correct? So how are we going to calculate? First, let's say Rahul is paying taxes under section 115 BAC. So shall we quickly calculate the tax liability? 1 second, I'll get my calculator. I hope students you are following me. Am I correct? So if you have any doubts, you can ask in live chat as well. I will reply. So let's calculate tax liability. He is paying taxes under section 115 BAC. So under 115 BAC up to 3 lakhs there is no tax. So what is step 1? There is no DTAA na. If there is no DTAA, unilateral relief will be given and tax liability is calculated in these 4 steps. Step 1, tax on total income. So how much is total income? 14 lakhs. How much is tax? Up to 3 lakh, tax amount is nil. Greater than 3 lakh, up to 7 lakh, tax rate is 5%, tax amount is 20,000. Greater than 7 lakh, up to 10 lakh, tax rate is 10%, tax amount is 30,000. Greater than 10 lakh, up to 12 lakh, tax rate is 5%, 15%, tax amount is 30,000. Greater than 12 lakh up to 14 lakh, tax rate is 20%. That means 2 lakh into 20%, 40,000, right? How much is tax? 40 plus 30 plus 30 plus 20, 1,20,000 rupees. To this, we are going to add HEC at the rate of 4%. Surcharge is not applicable because total income is less than 50 lakhs. Surcharge is not applicable. HEC at the rate of 4%. 4,800. So how much is tax liability? 1,24,800. This is step 1. Now, what we need to do? Step 2, we need to calculate average tax rate in India. Average tax rate in India. How much is average tax rate? 1,24,800 divided by 14 lakhs into 100. 124,800 divided by 14 lakhs into 100. 8.9142%. See, he earned 5 lakhs income outside India, right? On this 5 lakhs income, he paid tax 80,000 rupees. How much tax he paid? 80,000 rupees. So, how much is average tax rate in foreign country? Average tax rate in foreign country is equal to how much? 80,000 divided by how much is total income? Sorry, foreign income 5 lakh into 100. What is the percentage? 80,000 divided by 5 lakh into 100, 16%. Out of these two, whichever is lower means 8.9142%. Now, step 3, relief under section 91. What is doubly taxed income? Doubly taxed income is 5 lakhs. Do you agree with me? On 5 lakhs, he paid tax in country Y. He is also required to pay tax in India. So 5 lakhs is doubly taxed income. So 5 lakhs into tax rate as per step 2. What is tax rate as per step 2? 8.9142%. 5 lakh into 8.9142%, 44,000. 44,571 is tax credit. That is relief under section 91. How much is balance tax liability? That is step 4. Balance tax liability is 1,24,800 minus 44,571, 80,220. So this is how relief will be provided under section 91. I hope you understood very clearly. Very simple, very simple. If there is no DTAA, India itself will provide relief, but 4 conditions are required to be satisfied. Individual should be resident in India, he should have income from foreign country, he should pay tax in foreign country, then like India should not have DTAA with that foreign country. If these 4 conditions are satisfied, relief will be given under section 91. How relief will be calculated? First, calculate tax on total income. Second step, average tax rate in India or average tax rate in foreign country, whichever is lower. Step 3, relief is equal to doubly taxed income into tax rate as per step 2. Step 4, final tax liability is equal to step 1 minus step 3. I hope you understood. Now I am moving forward. Now I will take another example. Let's say same Rahul is there. In case of Rahul, Indian income is 10 lakhs. Foreign income 7 lakhs. Out of 7 lakhs, 4 lakhs is from USA, 3 lakhs is from UK. Sir, in this case, he is having doubly taxed income from multiple countries, and tax rate applicable in USA is 25%, tax rate applicable in UK is 22%. Sir, if income from multiple countries is there, then how to provide relief under section 91? That is the question. In that case, for each country separately, we are going to calculate relief under section 91. Are you able to understand? So in this case, how do we handle relief under section 91? First, we will take USA income. What we will do? Average tax rate in India or average tax rate in USA, whichever is lower we will consider. For example, let's say average tax rate in India is 30%. So 30% or average tax rate in USA 25%. Whichever is lower means 25%. So doubly taxed income into 25%, you will get relief under section 91 for USA income. Are you able to understand? Similarly, you will do the same thing for UK income also. So second, you will take UK income. Average tax rate in India or average tax rate in UK. Average tax rate in UK. Whichever is lower. Okay. In India, 30%. In UK, 22%. Whichever is lower means you will consider 22%. Now, doubly taxed income of UK into 22%, you are going to arrive at relief under section 91 for UK income. Are you able to understand? This is how we are going to give the relief. So, if income, foreign income is there from 2 or more countries, for each country doubly taxed income, you have to provide relief under section 91 separately in this way. Okay, for USA you have calculated relief separately, for UK also you have calculated relief separately. Are you able to understand? Shall I ask you another question? I hope you are following. There is again Monish. There is one student who is giving me replies in live chat. Monish. So I will take his example. So there is Monish. He has Indian income 10 lakhs. He has royalty income from outside India. Royalty income outside India, which is 7 lakh rupees. However, on this royalty income, he is eligible for deduction under section 80 QQB up to 3 lakhs. 80 QQB up to 3 lakhs. Now, when you calculate his gross total income, how will you do the calculation? If you do gross total income, Indian income is 10 lakhs, royalty income, income from other sources 7 lakhs. So gross total income is 17 lakhs. From that, you will claim deduction under section 80 QQB. How much is deduction? 3 lakhs. Now, how much is taxable income? Taxable income is 14 lakhs. My dear students, observe very clearly. How much is my foreign income? My foreign income is 7 lakh rupees. But am I required to pay tax on 7 lakhs in India? No. I am required to pay tax on 7 lakh minus 3 lakhs. I am required to pay tax only on 4 lakhs. Am I correct or not? Now, here doubly taxed income is 4 lakh rupees. Are you able to understand? See, in foreign, you paid tax on 7 lakhs. Do you agree with me? You paid tax on 7 lakhs. In India, you paid tax on 4 lakhs. Now, how much is doubly taxed income? Whether total 7 lakhs is getting doubly taxed? No, doubly taxed income is only 4 lakhs. So, while providing relief under section 91, you will not consider 7 lakhs, you will consider only 4 lakhs. So, relief under section 91 is equal to relief under section 91 is equal to doubly taxed income. How much is doubly taxed income? 4 lakhs into average tax rate in India or average tax rate in foreign country, whichever is lower. This is how you are going to calculate relief under section 91. Very simple, students. You need to provide relief not on total income on which like total foreign income. You need to provide relief only on doubly taxed income. Here foreign income is 7 lakhs, but you will not provide relief on 7 lakhs. You will provide relief only on 4 lakhs. Are you able to understand? Shall I give you another example? There is another person with the name Varun Chaudhary who is replying me. Now, there is Varun Chaudhary. His Indian income is 15 lakhs. He has one building in Australia. From building in Australia, he is getting rental income. Varun Chaudhary is resident in India. He is getting income from Australia. Let us assume there is no DTAA between India and Australia. So, his rental income from house property in Australia is 9 lakh rupees. Now, how much is taxable? As per Indian provisions, rental income is not taxable. Standard deduction is available under house property. So, when you are calculating his gross total income, how will you calculate? Like Indian income 15 lakhs, gross annual value 9 lakhs. From this, you will claim 30% standard deduction, right? 9 lakh into 30%, 2.7 lakhs. 9 lakh minus 2.7 lakhs, 6.3 lakhs is taxable. So his gross total income will be 15 plus 6.3, 21.3 lakhs. Now, please understand here foreign income is 9 lakh rupees. I am not objecting. But whether 9 lakhs is getting taxed in India? No. Only 6.3 lakhs is getting taxed in India. So here doubly taxed income is 6 lakh 30,000. So when you are calculating relief under section 91, what is doubly taxed income? Doubly taxed income is 9 lakhs. No, doubly taxed income is only 6.3 lakhs. On 6.3 lakhs, you will apply average tax rate in India or average tax rate in foreign country, whichever is lower. Are you able to understand? So my intention of explaining all these examples is to tell you that relief is available only on doubly taxed income. Relief is not available on total foreign income. Are you able to understand? Now, shall we discuss further? Now, we will do one problem for better understanding. My dear students, I am going to share this PDF in our Telegram channel so that you can also participate effectively. Uh, Give me 1 second. I am going to share with you. So if we do some 2-3 problems, that will be a great revision for us. So let's do. First, I will discuss question number 2. So there is Mr. Rohit, an individual who is resident in India, aged 52 years, earned royalty income of 15 lakhs from XYINC of Canada for writing articles in journals and newspapers for the year ended 31st March 2025. So, Rohit is basically resident in India. he is getting income from Canada. How much is the income? 15 lakh rupees. And the nature of income is royalty. See, if you remember 80 QQB, for arts, science and literacy, with regard to these three, if you write any books and earn royalty income, then only deduction is available under section 80 QQB. Here, why royalty income was earned? Royalty income was earned for writing journals in newspapers. For writing journals in newspapers, if you earn royalty income, that is not eligible for deduction under section 80 QQB. So, for solving these DTAA problems, you are expected to have knowledge of those chapter 6A deductions also. Okay. Now, however, he received only 12.5 lakhs during previous year 24-25 and the balance is outstanding as on 31st March 25. He maintains cash system of accounting. He also earned rental income of 2.4 lakhs from a house situated in Canada. See what he said, rental income. Rental income is not income from house property. Many times student will mistake. Okay, they will consider rental income as income from house property. Entire problem will go wrong. Rental income means it is gross annual value. From that you should claim standard deduction under section 24A at the rate of 30% of net annual value. So this 2,40,000 is gross annual value. From that you should claim standard deduction. Balance is income from house property and this house property is located in Canada. So income from foreign house property. So here doubly taxed income is not 2,40,000. From 2,40,000 you will reduce standard deduction. After reducing standard deduction, whatever the balance income is there, only that is doubly taxed income. Are you able to understand? Next. Municipal taxes paid 10,000 rupees, which is not allowed as deduction in Canada. Even though it is not allowed as deduction in Canada, while calculating income from foreign house property, it is allowed as deduction in India. Okay. DTAA between India and Canada provides for tax at the rate of 15% in Canada without prejudice to taxation of same income in India. So what is tax rate applicable in Canada? 15%. He further received 3,50,000 during the year as dividend from X Limited, an Indian company. Dividend is taxable under income from other sources. On 1st April 2024, he took an education loan from bank for his son. Education loan, how to remember? E represents education. So, deduction is available for interest on education loan under section 80E. Are you able to understand? Annual repayment of loan and interest. Whether loan amount is eligible for deduction under 80E? No. Interest amount is eligible for deduction under section 80E. So we need to compute total income and tax liability. So here answer was given. If you want me to solve, I will also solve, not a problem. Now, tell me total incomes. He is having three incomes now. Indian income is dividend income, foreign income is royalty income, as well as another one income from foreign house property. These two are foreign incomes. So rental income 2,40,000 you can see. Rental income is only gross annual value. From that you will claim municipal taxes as deduction. Thereby you will arrive at net annual value. From net annual value, standard deduction is allowed at the rate of 30%. So 2,30,000 into 30%, 69,000 is standard deduction. Income from foreign house property. Income from foreign house property, how much? 1,61,000. Next, royalty from Canada for writing articles in journals. I already said you need to be very careful. Literacy, arts, science. These three related books are written on royalty income. Then deduction is available under section 80 QQB. Otherwise, deduction is not available under section 80 QQB. Are you able to understand? So here it is for writing journals. So no deduction. Only amount which is received during the previous year is includable since he follows cash basis. That's what, right? In PGBP we have liberty. What is charging section? Section 28. It says that SSC can follow either cash basis or accrual basis as may be followed by him. Okay. So method of accounting for PGBP is cash or accrual basis. Here he is following cash basis, so we taxed only 12,50,000 rupees. Next, income from other sources. Do you know section 94, 194? As per section 194, TDS will be deducted on dividend income. Okay, so you know, right? 100 rupees, 10 TDS at the rate of 10%, and 90 will be paid. Am I correct? 90 will be paid. Here, how much dividend is paid to him? Dividend paid to him is 3,50,000 rupees. So we will assume 3,50,000 is at 90% level. We need to do gross up. If we do gross up, how much are we going to get? 3,50,000 divided by 90 into 100. 3,88,888. Are you able to understand? So we need to do gross up also. So then how much is total income? Total income is 17,99,889. From this, we will claim interest on education loan. Interest like deduction under 80 QQB not available. So how much is total income? 17,75,889 rounded off to 17,75,890. So can we calculate average tax rate in India? How much is average tax rate, Monish? Average tax rate in India is equal to 17,75,890 divided by how much is total income? Sorry, we did not calculate tax liability, right? So first we need to calculate tax liability. Calculation of tax liability on total income. Total income means both Indian income and foreign income. So total income we already calculated now, 17,75,890. Whether SSC is following, he does not opt 115 BAC. That means he is paying taxes under optional tax rates. Under optional tax rates, he is 52 years old, less than 60 years. The basic exemption limit available is 2.5 lakh. Up to 2.5 lakh, tax amount is nil. Greater than 2.5 lakh, up to 5 lakh, tax rate is 5%, 12,500. Greater than 5 lakh, up to 10 lakh, tax rate is 20%. Tax amount is 1 lakh. About 10 lakh, tax rate applicable is 30%. Correct? So 7,75,890 into 30%, 232,767. Total 345,267. So this is tax liability. Now how much is average tax rate in India? Average tax rate is 3,45,267 divided by taxable income in India, 17 lakh 75,890 into 100. How much? 19.44%. Did I do any mistake? Okay, I forgot to add HEC. 345,267 plus 4%. I'm sorry. Plus HEC. 3,59,078. 3,59,078 divided by 17,75,890. 20.219%. Good. Now, how much is tax paid in foreign country? Tax paid in foreign country is 15%. 20.219% or 15%, whichever is lower means 15%. How much is doubly taxed income? Doubly taxed income. 1,61,000 and 12,50,000. Doubly taxed income 12,50,000 plus 1,61,000. Doubly taxed income 14,11,000. 14,11,000 into 15%. Relief under section 91. 2,11,000. So that is relief under section 91. I hope you understood. See, I did one mistake. That's fine. I already cleared in my life again. Never, I am not required to write CA examination. Glad. Okay. But you should not commit that mistake. After becoming CA, it's okay. Software will take care of. Even though you commit any mistake, you are not required to do any clerical calculation. Correct? Now, shall I explain further? Next concept is permanent establishment. If you are doing business with outside India, then foreign country will not levy tax. But if you are doing business in foreign country, then foreign country is going to levy tax. That concept we call as permanent establishment. For example, let's say I am sitting in India, I am providing my professional services to a client located in USA. Now, I am not doing business in USA, I am sitting in Hyderabad, I am providing services to client located in USA. Now, do I have any branch or fixed place of business in USA? I do not have any branch or fixed place of business in USA. So, I am not having any permanent establishment in USA. However, case 2, I went to USA, I opened one office there. From there, I am providing services. When I provide services from office in USA, I am opening separate branch in USA. There, if I earn any foreign income, if I earn any income in USA, on that income, I am also required to pay in USA. So the concept is when you have permanent establishment in India, when you have permanent establishment outside India, then whatever the foreign income that you earn through that permanent establishment, on that foreign income, you are required to pay tax in foreign country. Otherwise, you are not required to pay tax in foreign country. See, I am doing practice from India only. From India only, I am giving suggestions to client located in USA. I did not open any branch. Now, I will get fees. On that fees, I am required to pay tax in India, but I am not required to pay tax in USA. So, when you do business with foreign country, you are not required to pay tax in foreign country. But when you do business in foreign country means what? You are doing some setup in outside India and through that you are earning income. Then you are required to pay tax in foreign country. The permanent establishment means what? Any branch, fixed place of business or sales outlet, manufacturing unit like this. If you open any office outside India, then we call it as permanent establishment. When you have PE outside India, whatever the foreign income that you earn through that PE, on that foreign income you are required to pay tax in foreign country. Vice versa, non-resident opened PE in India. So through that PE in India, if he earns any income, he is required to pay tax in India. Are you able to understand? One simple thing here, small thing, license office. Opening of license office to comply with regulations of RBI cannot be considered as permanent establishment. So if you open license office, it will not be treated as PE. Are you able to understand? Taxation of business process outsourcing units. See, there are two companies. One is Trump Inc. and Modi Inc. Modi Limited. Modi Limited is Indian company. Trump Inc. is US company. Now, what Trump Inc. is doing? Trump Inc. is like giving work to Modi Limited. On this work, Modi Limited will pay tax in India, right? Modi Limited will pay tax in India. As Modi Limited is paying tax in India, through this work, if any income is earned by Trump Inc., Trump Inc. is not required to pay tax in India. Not required to pay tax in India. Both are principal to principal. Trump Inc., Modi Limited, both are acting independently. Both are in between them. The relation is principal to principal relation. Whenever the relation is principal to principal relation, in that case, Trump Inc. is doing business with India. When Trump Inc. is doing business with India, there is no concept of PE. Trump Inc. is not required to pay tax in India. Are you able to understand? Now, I will take example 2. Trump Inc. has one branch in India. That branch name is Trump Limited. Trump India Limited. Now, Trump Inc. is giving work to Trump India Limited, and Trump India Limited, and he is making money out of it. Whenever he is having branch in India, whenever he is having permanent establishment in India, then Trump India Limited is required to pay tax in India. Are you able to understand? So Trump India Limited, it is subsidiary of Trump Inc. It is having permanent establishment in India. Now Trump India Limited is required to pay tax in India. In both cases, tax is required to be paid, but when business is done, foreign company will not pay tax in India. Whoever the agent in India acting on principal basis is there, he will pay tax in India. In second case, if you are having PE, then PE will pay tax in India. Are you able to understand? Next, I will discuss with you my dear students, that concept now I am going to discuss. It will be very interesting. I am going to simplify and give it to you. Now I will explain to you how to convert foreign currency to Indian currency, how to convert tax paid in foreign country to foreign country into Indian currency. First, conversion of, sorry, exchange rate for conversion of foreign income into Indian income. Exchange rate for conversion of foreign income into Indian income. First, nature of income. If nature of income is salary income, dividend income, interest on securities, capital gains, and TGBP income of non-resident shipping business, NR shipping business. So all these incomes, foreign incomes, if you want to convert into Indian currency, what is the exchange rate that you need to take? You need to consider exchange rate as on last day of month, last day of the month, as on last day of the month, immediately preceding the month, immediately preceding the month in which salary is due, salary is due or received, or in which dividend income is declared or paid, or distributed. Interest on securities, in which interest income is due, in which capital asset is transferred, in which such shipping income is deemed to accrue or arise in India, deemed to accrue or arise in. Very, very, very simple, students. You are getting salary income from outside India. The month in which you got the salary, ignore that month. Take immediately preceding month. In immediately preceding month, take the last day. On last day, whatever the TTBR of SBI is there, okay, that will be the exchange rate. What do you mean by this? Let's say in May, you got $12,000 salary. On May 10th, you got $12,000 salary. Ignore May. Don't consider May. What is immediately preceding month? Immediately preceding month is April. In April, what is last day? Last day is 30th April. Am I correct or not? Last day 30th April. On 30th April, whatever TTBR of SBI is there, TTBR of SBI, that will be the exchange rate. Are you able to understand? So, dividend income, salary income, interest income, capital gain, PGBP income of NR shipping business. You know section 44B, right? Non-resident shipping business. 7.5% of income is taxable in India. So in case of that non-resident shipping business, 7.5% of turnover will be considered as deemed income. Okay. So the deemed income or interest income, dividend income, salary income, capital gains. All these 5 incomes, in which month you are getting these incomes? Ignore that month. Take immediately preceding month. In immediately preceding month, whatever the last day is there, on that last day, TTBR of SBI will be considered as exchange rate. Are you able to understand? Fantastic. Simple, right? Very simple. All 5 incomes you need to remember: salary, dividend, interest, capital gains, PGBP income of NR shipping business. For these 5 incomes, this month, the month in which you got them, ignore immediately preceding month, last day, TTBR of SBI is considered as exchange rate. Are you able to understand? Now, I hope you are following. Next. Sir, what about other incomes? You have income from house property. You have PGBP income. Sir, PGBP income is covered here. Other than this PGBP income, PGBP other than covered above. Other than covered above. Next, income from other sources other than dividend, interest on securities. Other than dividend and interest on securities. So, for these 3 incomes, you will consider exchange rate as on last day of previous year. Exchange rate as on last day of previous year. What is exchange rate as on last day of previous year? Exchange rate as on last day of previous year means exchange rate. That means TTBR of SBI as on 31st March of previous year. As on 31st March of previous year. Did you understand? Next. Sir, what is the exchange rate for tax paid in foreign country? Let's say you earned $1 lakh. On $1 lakh, you paid tax $15,000. For this income, we have discussed if it is salary, interest, dividend, capital gains and all, you will consider exchange rate immediately preceding the month, last day exchange rate you will consider. Okay, so then whatever exchange rate for tax paid in foreign country. So for this you will consider TTBR of SBI as on last day of month immediately preceding the month, immediately preceding the month in which tax is paid in foreign country, in which tax is paid in foreign country. What do you mean by this? For previous year 24-25, on June 21st, 2025, you paid tax $15,000. How much tax you paid? $15,000. Ignore June. Don't consider June. Immediately preceding month, May. What is last day of May? 31st May. On 31st May, whatever TTBR of SBI is there, that will be considered as exchange rate for conversion of foreign tax paid. Are you able to understand? So these are conversion rates. Now, shall we do one problem for better understanding? I hope students you understood exchange rates for conversion of foreign income and foreign tax. Am I correct? Now, shall we do one problem on this? Like, if foreign income is given in Indian rupees, it will be very easy. You can solve very easily. But if foreign income is given in foreign currency, dollars, euros, pounds, like that, then you need to apply these exchange rates. You need to convert foreign income to Indian rupees, and you also need to convert tax paid in foreign country to Indian rupees. Are you able to understand? Now, shall we do one problem, everybody? Open question number 1. Raghu, aged 50 years, is CEO of Silver India Limited since 1st April 2020. His income in India consists of salary before standard deduction 23,25,000. Check. Salary before standard deduction. How much standard deduction is available? Under optional tax rates 50,000, under default tax rates 75,000. Am I correct? So, compute total income and tax liability. Assume he pays tax under 115 BAC. If he is paying tax under 115 BAC, then what is the standard deduction available? Standard deduction available is 75,000 rupees. Interest in respect of self-occupied property of rupees 1,80,000. See, this is eligible for deduction under section 24B. But he is choosing 115 BAC na. If he is choosing 115 BAC, under 115 BAC, interest on self-occupied property is not allowed as deduction. Are you able to understand? That is not allowed as deduction. Interest on bank fixed deposit, this is taxable under income from other sources. He has following income for the year ended 31st March in country A. Income from business in country A. Income from business, what is the exchange rate that you need to consider? Income from business. If it is business income of non-resident shipping business, then you will consider exchange rate as on last day of immediately preceding month. But this is normal business income. For normal business income, you will consider exchange rate as on 31st March of previous year. You can see PGBP income other than covered above. You will consider exchange rate as on last day of previous year. So how much is exchange rate as on 31st March? As on 31st March, exchange rate is 71 rupees. So you will convert $25,000 by applying 71 rupees. How much? 25,000 into 71. 17,75,000 rupees. Next, rental income from house property in country A. Income from house property. This will also be considered at exchange rate as on 31st March of previous year. So as on 31st March, exchange rate is 71. So 4,500 into 71. How much? 3,19,500. Municipal taxes in respect of above house not allowed as deduction. Even though it is not allowed as deduction in country A, it will be allowed as deduction in India as per Indian tax laws. As per Indian tax law, whatever the taxes, municipal taxes paid in foreign country are there, they are allowed as deduction from gross annual value. You can claim as deduction. Even 450 also converted at exchange rate of 71 rupees. Next, dividend from shares in country A where dividend was declared in March 25. Careful. Dividend income. So for dividend income, what will you consider? In which month dividend came? Dividend came in March 2025. Don't consider March 2025. Consider immediately preceding month. What is immediately preceding month? February 2025. What is last day? 28 or 29, because February leap year. Some years it is 28, some years it is 29. So how much is exchange rate as on 29th February? Exchange rate as on 29th February is 70 rupees. So $10,000 into 70 rupees. Are you understanding how we are converting foreign income in foreign currency to Indian currency? Crucial. If this type of problem comes, you should be able to handle it. So 10,000 into 70, how much? 70,000, 7 lakhs. Next, short-term capital gain of 5,000 US dollars. Short-term capital gain. Capital gain, what will you consider? Ignore that month. Take immediately last month, preceding month. On the immediately preceding month, consider last day. On last day, whatever TTBR of SBI is there, that is exchange rate. So it is also received on 28th March. Immediately preceding month means February. In February, last day means 29. Exchange rate is 70. Okay. So 5,000 into 70. So in this way, you will convert foreign income. Here foreign income is in US dollars. But to calculate tax in India, you should convert foreign income to Indian income. So we have discussed the exchange rates. I hope you are following. Now let us read further. India has DTAA with country A, and tax paid in country A is eligible for tax credit in India. Fiscal year for income tax is same both in India and country A. Rate of tax is 20% in country A in respect of all incomes. Income tax was paid by Mahesh on 25th May 2025. So when income tax was paid, this is exchange rate for tax paid in foreign country. Tax paid in foreign country. So how much is when tax was paid? Tax paid in 25th May na, tax paid in 25th May 2025. So you need to ignore May. Immediately preceding month means April.